when it comes to my strategy, the first thing I look out for is the market structure. I will have to read the market structure to know whether the market is pushing up or whether it is pushing down. So I'm going to outline everything and then we'll pick them one after the other and explain them. So like I said, the first thing I look out for is to read the market structure from the higher time frame all the way down to my entry time frame, which is a 15 minutes time frame. So I'll have to read the market structure. Now when it comes to reading the market structure, I will give an illustration then before we head straight to the chart. And I'm also going to drop a video where you understand how to read the market structure like a pro. So stay tuned, and also don't forget to subscribe, turn on the notification bell so that you'll be the first to be notified when I upload that particular video. When it comes to the market structure, there are three types of market structure. We have when the market is given, higher highs and higher low. Now breaking structure to the upside, higher highs, higher low, higher highs and higher low. Now when the market is behaving this way, that simply means we are bullish. This is a bullish market structure. Then when you see the market breaking structure to the upside like this, breaking structures to the upside, playing out key levels to the upside like this, that indicates a bullish trend. The second one is if you see the market trending, giving lower lows, lower highs, lower lows, lower highs, lower lows, lower highs like this. So that shows that the market is bearish. That shows that the market is bearish, which means it is pushing to the downside. That shows the market is bearish. It is pushing to the downside, breaking structure to the downside. And now when you notice that the market is either bullish or bearish, that should give you the bias you are looking out for. Now we have the next type of market structure, which is when the market is consolidating, giving equal highs and equal lows. Following my strategy, these are the three types of market structure. Now my strategy only allows me to trade when the market is either bullish or bearish. When the market is consolidating like this, we call this one, you can call it a ranging market or sideways movement. So I'll just call it sideways movement, sideways movement. So when the market is ranging like this, I stay out. That is because if the market is giving a sideways movement like this, there is no direction yet. You just need to wait until there's a direction. Now what I mean by direction, the market should either break to the upside or to the downside for there to be a direction. But looking at this, when the market is bullish, there's actually a direction. That simply means it is pointing to the upside. The market is saying that we should buy, that there are more buyers in the market. So that will give me the bias that particular currency pair I'm looking at, I should be looking for possible buy setups and not sell. Same thing is applicable to when the market is bearish. If the market is bearish, what I'll be looking out for is possible sell setups, because what the general trend is telling me is that there are more sellers, and it will not be a wise decision for you to notice that there are more sellers in the market and you are trying to buy. That simply means the probability of your trades playing out will be very low. So that is the first thing I look out for, the market structure. And when I'm reading this particular market structure, I start from the daily time frame to read the market structure all the way down to 15 minutes time frame, which is my entry time frame. So that simply means if I point out that the market is bullish from the daily time frame and the market is also bullish from 4 hours, I'll just be moving down to different time frames, making sure that the trend align with all the time frames. And then once I get to my 15 minutes time frame, that is my entry time frame, I will now look out for possible setup that is also pointing to the upside. That is if I've pointed out that the market is bullish, and then I'll be looking out for possible setup that says I should buy. Now if the market is pointing to the downside, stating that it is generally bearish, I will go down to my entry time frame and be looking out for possible sell setup. And when the market is giving a sideways movement like this, I will totally stay off, because this simply shows that there is no direction in the market yet. So what I will need to do is to just calm down and patiently wait until there's a breakout, whether to the upside or to the downside. If it's to the upside, I'll position for a buy. If it's to the downside, I'll position for a sell. So that is the first thing I look out for whenever I want to take trades. I'll read the market structure. So the second thing I look out for is, once I point out what the market structure is, which is the first thing, once I point out what the market structure is, the first thing I look out for is to go down to my entry time frame to look out for break of structure, that is the last break of structure to the upside, the last break of structure either to the, if I've pointed out that the market structure is bullish, I will go down to my entry time frame to look out for break of structure to the upside, which will give me the bias to, you know, buy. But if the general market structure is saying that it is bearish, I'll also look out for break of structure to the downside, which will be giving me the sell bias I need on the chart. Now, you may be wondering what break of structure means. Now, if the market is moving, when market is moving, we have what we call the resistance level and we have the support. So let me change the color of this one. So the green one represents the support level while the red one represents the resistance level. Now when the market is moving, we have these levels. That simply means if there is a buy from a level, if there is a particular zone pushing up, pushing the market up, so where that market is pushing up from is more like your support level, because that has triggered a buy. So normally for support and resistance level traders, once market gets to support level, they will buy. Once it gets to resistance level, they will sell. So I'm just using this to give you an example of when a break of structure happens. So market is pushing up, giving out a buy from this support level to the upside. Now as market is moving, there are levels it will get to and there will be a little retracement and it will push up again. There are still levels it will get to and there will be a little retracement. Now these levels that market has gotten to and their retracement, you can call this a resistance level, because for market to get here and then it will stop the buyers from pushing up further, and then there will be a little retracement before there is, you know, a break. That serves as resistance level. So any more like, let me make it to, you know, let me give it a literal meaning. So whenever the market is pushing up and there is a particular level that stops it from pushing up, instead of pushing up, it will now push down. That level is what we call resistance level. And now whenever the market is pushing down and it gets to a particular level and that particular level, you know, stops it from pushing down and instead retraces the movement and pushes it back up, that is a support level. So now looking at this particular illustration I have here, you can see this particular level has, you know, pushed this particular sell, it has pushed this particular buy down. So you can see market was actually pushing up here and it got to this particular level and then we got this retracement. That simply means this is a resistance level. And now if the buy is strong, like if the buyers, they're more like stronger than the sellers in the market, if market should now come or the price should now break that particular structure to the upside, that is when we can now point out that there is what? A break of structure. So that is when we can now point out that there is a break of structure. You can see market has broken this particular structure. That simply means market has broken the resistance level. That is a break of structure. So that simply means break of structure means whenever a key level in the market has been taken off, that becomes a break of structure. So that's the second thing I need to look out for on the chart. Once I get the general market structure, that is number one, I'll look out for, I'll go down to my entry time frame. If I've pointed out that the general market structure is bullish, for instance, that simply means I will go down to my entry time frame and look out for the most recent break of structure to the upside, and then I will point that out. Now, after pointing out the most recent break of structure to the upside, the next thing I will need to do is to bring out the origin that caused that particular break of structure to the upside or to the downside. So the next thing I need to look out for is to bring out the origin that caused that particular break of structure, the origin. Now remember, the first one I said you need to read the market structure. Second one, you need to point out the break of structure, the most recent break of structure aligning with the market structure. Then the next one is origin. Now this is what I mean. Now let's say we've pointed out that the market is bullish. That simply means we'll come down to my entry time frame and then I'll look out for the most recent break of structure. So let's say this is the most recent break of structure to the upside when the market is bullish. This is the most recent break of structure to the upside. What I mean by the origin simply means the last consolidation that happened before the impulsive movement that broke the structure. So, or where the impulsive movement started off from. So if we are looking at the chart now, you know, I'm more like giving an illustration and you can see how beautiful the illustration is, but I bet you most of the times it doesn't look beautiful like this on the chart. So that's why we'll still go to the chart and you will see how I will point them out. So when we are talking about origin is actually the last consolidation that happened before the impulsive movements that cleared out the structure. So if we are pointing out the origin, it will be here. That is where the movement started from. So my origin, once I point out origin, that simply means I am warming up to take trades, because the origin serves as my point of interest. What do I mean by point of interest? Point of interest simply means where I am looking to take my trades from. So since I've pointed out that the market is bullish and I've gotten my breakout structure to the upside, the next thing I need to look out for is to wait for price to get into my origin. Then I will buy again and take my profit from the point of reversal. So that is the strategy in total. Now, when trading out of the origin, there are things I also need to see very close to my origin for it to be a valid origin for me to take trades. So I don't just see origin and then rush and place my trades. There are things I need to see very close to my origin for me to be more confident that that origin is valid. So what are those things? The first one is I need to make sure that there is liquidity. Market needs to sweep before it taps into my origin. Liquidity. I need to make sure that there is liquidity. Market needs to sweep to tap into my origin. So how do we get to know what liquidity means? Now, before market taps into my origin, I need to make sure I see something like a key level. Let's say market was pushing down to tap into my origin, and then there is more like a key level there where a retracement happened and it's looking as if that the market is leaving me. So now this particular key level that is very close to my origin is what I call liquidity. And if I'm pointing it out, I point it out as, with a dollar sign, showing that money is sitting there. Now, liquidity simply means where money is sitting, and where money is sitting. That is where a trader can see, see and decide to place trade. Mostly, retail trading strategy, all these support and resistance levels, and W pattern, M pattern, all those things. So once I see that there is a key level very close to my origin, that serves as my liquidity, because if it's not there, that simply means once market comes to my origin, it can sweep me out before it will go to my direction. That simply means my entry will now be the liquidity. So I need to make sure that there is liquidity. Market will sweep to tap into my origin. So from this illustration, this is the liquidity. And the next one, not just liquidity, the next one I also need to see is to make sure that we have imbalance present. Or very close to my origin. Now, when it comes to my trading strategy, this trading strategy, it's called smart money concepts. That is why I trade SMC strategy. Now, when it comes to SMC strategy, you can either take your entry from the imbalance or order blocks. So when we go to the chart, I will explain how to refine your origin with the order block candle. So you can either take your trades with imbalance. Once you point out that there is an imbalance on the chart, you can take your trades from that, or you take your trades from order block. But personally, I take my trades from order blocks. But I use imbalance as part of the confluences I need to see very close to my origin for it to be valid for me. Now, what is imbalance? Imbalance simply means when there is an unequal movement in the market, just the gaps price creates on the chart. So you can either call it imbalance or you can call it fair value gap and so on. So using this illustration now, you can see when the market pushed up, you can see from here to where my entry is, there is a gap. That market has not filled. So using this illustration, the gap from here to here can be called imbalance. So let me also give an illustration for a clearer understanding. So let's say we have the market pushing up like this, and you can see this particular candlestick closed here. Now, it's expected that there should be an equal movement between the buyers and the sellers, but when it is not equal, that is when imbalance happens. So we can see this particular candlestick closed here. Now, it's expected that the next candlestick should open. And then we have more like a retracement covering up the gap of this particular candlestick before there will be another movement. But when that does not happen, let's say the next candlestick opens immediately and start pushing up from where the other one closed, something like from here, it will start pushing up. That simply means from here to here is an imbalance. There's an imbalance there because market did not cover up the gap created by this particular candlestick. So there's actually an imbalance. You will get this clearer once we'll get straight to once I open the chart. So I'm just trying to give an illustration so that you understand what I'm talking about. So that is what I need to see. So from my illustration here, you can see this gap here is actually an imbalance. So once I see all these things present, I do not hesitate at all. What will I do? I'll put my pending order immediately, my stop loss a little bit below my origin, take profits at the point of reversal. That is where market started pushing down from, the point of reversal, and then I will target there and wait for price to just tap me in, my pending order intact, wait for price to just tap me in, and then I'll push to the upside. So using an illustration, what you can see here is just my strategy in one picture. So this is my strategy, and these are the confluences I need to see. The first one is to read the market structure. Second one is to point out, once I read the market structure and I point out that the market is bullish or whether it is bearish, the next thing I need to do is go down to my entry time frame, point out a breakout structure. If it's bullish, I'm looking for a breakout structure to the upside. If it's bearish, I'm looking for a breakout structure to the downside. And then I'll wait for price. I'll point out the origin, then the two things that will make my origin valid, which is liquidity imbalance, and that will be there. And then I will take my trades without stress, no hesitation. Remember, execution is the key. It's not just about you analyzing. You just need to make sure that once you see your setup, you take your trades. That's what makes you a trader. You're not just a trader by looking at the chart. The chart should pay you. Have that in mind. So these are all the things I look out for whenever I want to take trades. So I'm going to open the chart now and then also show you guys some of the setups I have taken using my strategy to also see how I point them out on the chart. I'm going to leave this list. You can go ahead and take the screenshot, and if you have any question concerning any of them, feel free to drop your questions in a comment, and don't forget to like this particular video and also subscribe so that you will always be notified whenever I am uploading a new video. So opening the chart. So this is GBP JPY. So GBP JPY, this is one of my favorite pairs, and if you look at it, this is from the daily time frame. If you look at it, you will notice that price, we are currently reading the market structure now, which is the first one. That's the first one here. I want to read the market structure. So if you look at GBP JPY, you will notice that price is breaking structure to the upside. We have this breakout structure to the upside. So with this is actually indicating that market is bullish. We have this breakout structure to the upside. This is also a breakout structure, no matter how tiny it is. Once a structure has been taken off, is a breakout structure. This is a breakout structure. This is also another breakout structure, and this is also a breakout structure. So you can see market is breaking structure to the upside, which is indicating that we should be looking out for how to buy GBP JPY. So whenever you read the market structure and you notice that this is what we have, market pushing up, giving us higher highs, higher low, higher highs, higher low, higher highs, higher low, higher highs, higher low, just like this. That simply means we are bullish and we should be looking to buy. So having that in mind, looking at it from other time frames, you will still see that we are bullish from all angles. So even from 4 hours, you can still see this particular. Let me reduce this. I'm cloning the drawing. So you can still see that we have this particular break of structure here to the upside. So having it in mind, you can see generally we are bullish on GBP JPY. So that simply means I will go down to my entry time frame. Now currently the market is closed as I'm shooting this video. The market is closed, but if I'm to take a trade from the market analysis, that's the market structure, our top-down analysis from the higher time frame all the way down, if I'm to take a trade, what I'll be looking out for, you can see that clearly this is the most recent breakout structure here from 15 minutes time frame. This is the most recent breakout structure here. And then the next question is, where is the origin that caused this particular breakout structure? Now you can see this is the last consolidation. You can see this is the consolidation that happened before the impulsive movement that cleared out this particular key level. Now this is a key level. I'm explaining everything now. This is a key level here, which caused, you can see this is a key level. When price got there, there was a sell. Price got there again, a sell, a sell-off, a sell-off. So this is more like a resistance level. But you can see from here, market cleared it to the upside, which simply indicates a break of structure. Now I've pointed that out. The next thing I need to look out for is our origin. Now, generally, all this consolidation that happened here before market took off is actually our origin. Now, remember I told you guys that I'm going to show you guys how you refine it to your order block candlestick. Now, if you are trying to map out the origin like this, it will be large, because if you measure your stop loss using your origin. Now, if we do it like this, you will notice that this is, kind of massive. If I extend it, if we are looking to take trades from this particular level, you will notice that this is massive for taking entries, because you can see where our stop loss is. It's kind of massive. But now watch me refine this to the last order block candlestick. Now, when we are trying to refine it inside the origin, you look out for the last candlestick, whether bullish or bearish. You look out for the last candlestick before what the impulsive movement that caused the breakout structure. So zooming it, you can see that this is the last candlestick, this particular candlestick. So what will you do? You measure it from where it's closed to where it opened. You measure it. That will now be the size of your point of interest, your origin. So that represents the order block candlestick. So now, also viewing it, the next thing now to know whether this our origin is valid is to look out for liquidities. Now, if you check here, there is more like this consolidation, all this, this consolidation that happened here, all these little key levels here. Some may be looking to take a buy from this particular level for market to start pushing up. I'm not saying that it may not work. At the end of the day, we are all speculators in the market. That's what you need to understand. There is nothing like the holy grail strategy, all knowing in the market. And you just need to understand that there is no certainty when it comes to trading. Nothing is guaranteed. We just use our strategies to more like speculate and take our trades. So don't feel like you should know it all more than another person. Those trying to take trades from here may be right, or at the end of the day, they may also be wrong. So what you just need to do is, the worst thing that can happen is the market hitting your stop loss. So now, following my strategy, I will see this particular level as a liquidity zone, because I know most traders will be trying to place trade here. Once market gets to this particular level, they'll be trying to place trade at this particular level. But what I will see that place as, it will be my liquidity, because I'll be expecting market, when it is coming down, I'll be expecting it to clear out this particular level before it taps into the main demand zone that will push this particular price up. So I will not be looking to take a buy from here. Instead, I'll patiently wait until price gets to this particular level. So that simply means, from the list of my confluences, I have gotten my liquidity zone. So I'll just more like point it out like this as liquidity. So this is more like showing itself as, let's say, trend line liquidity at this level. Sometimes it can be a key level, because there is a possibility that market may come here and still react, try to push back up before there will be a push down. So I'm mapping this out as my liquidity zone, where I'm expecting market to sweep before it taps into my zone. Now, the next question is, where is my imbalance? Now, if you check very close to our order block candlestick, you can see when this particular candlestick closed, you can see where it closed. This one opened, we got another open, to the upside. and from there you can see from the line where this one closed, this particular long candlestick pushed up and closed here. Another one opened immediately, tried to cover up the gap caused by this particular candlestick, but it didn't finish it up. So you can see from here, it didn't clear out or it didn't close up the gap. So from this particular line to this particular line, we have imbalance present, and it's very close to our origin. This is another thing you also need to point out. When you're looking at the chart, you may be pointing out, different imbalance here and there. You just need to focus on the imbalance that is very close to the origin that you are looking to take trades from. So you can see this is the imbalance we have. This has added more confirmation for me to see this particular origin as a valid origin. So what will I be waiting for? Once price gets here, I am doing what? I am buying GBP, JPY, and my stop loss will just be a little bit below my origin, and then my take profit will be from the point of reversal. So you can see from here, market is already reversing from this particular level. So I'll be waiting for it to get into this particular zone, trigger my order, and then we'll keep buying. I'll take my profit here. So this is just what I explained when I was trying to illustrate it. You can see it clearly on the chart. So I will advise, before you use this particular strategy, go ahead, practice it, practice with your demo, and check if the strategy works for you, if you understand everything that comes with the strategy clearly. And don't forget, if you have any question, feel free to drop in the comment. I will answer immediately. So guys, thanks for watching. Don't forget to subscribe to my YouTube channel and turn on the notification bell so that you'll be the first to be notified when next I upload a video. Bye for now.